You got a raise. Congratulations, you're richer now. Except, you're probably not. Because while your paycheck got bigger, something else got bigger too. The price of food. The price of rent. The price of gas. The price of almost everything. And if your money buys less than it did before, are you actually richer? Welcome to inflation, the most misunderstood force in modern economics. The hidden tax nobody votes for. The silent transfer of wealth that happens every single day. And the strange part? While millions of people struggle with rising prices, some people get richer because of them. A lot richer. This is the story of why inflation makes the rich richer, and why understanding it might completely change how you see money. Because inflation isn't just about rising prices, it's about power, ownership, and who gets the new money first. Every time inflation rises, people focus on the symptoms: more expensive groceries, higher rent, bigger utility bills. The cost of living keeps climbing, while the purchasing power of ordinary households keeps falling. Everyone asks the same question: why do prices keep rising? The answer sounds simple: too much money chasing too few goods. But that explanation barely scratches the surface. Inflation economics isn't really about prices. It's about money creation, central banking, monetary policy, and how the modern monetary system actually works. To understand inflation, we need to go backward. For most of human history, money was tied to something physical, gold or silver. Under the gold standard, governments couldn't simply create unlimited currency. Every paper note represented something scarce and difficult to produce. If governments wanted to spend more, they needed higher taxes or more borrowing. There was no easy escape. Inflation existed, but it was generally associated with war, crisis, or economic collapse. Monetary discipline wasn't optional. It was built into the system itself. Then came the Great Depression. Prices fell, businesses collapsed, banks failed, and unemployment exploded. This wasn't inflation, it was deflation. And deflation terrified policymakers. When money becomes more valuable over time, people stop spending. Businesses stop investing. Debt becomes harder to repay. Economic growth slows. The entire economy begins to freeze. That experience fundamentally changed how governments and central banks viewed money. Inflation stopped being seen purely as a danger and started being viewed as a tool. After World War II, governments had enormous levels of national debt and sovereign debt. The war had been financed through massive government borrowing, leaving countries buried under obligations they could never realistically repay through taxation alone. But inflation offered a solution. As prices rose over time, the real value of government debt fell. The debt remained the same on paper, but its purchasing power shrank. Policymakers learned an important lesson. Moderate inflation could quietly reduce debt without creating the political backlash of higher taxes. Then came one of the most important events in monetary history, the Nixon shock of 1971. President Nixon closed the gold window, ending dollar convertibility and effectively dismantling the Bretton Woods system. The dollar was no longer directly backed by gold. The world entered the era of fiat currency. For the first time, money could be created primarily through policy decisions rather than physical constraints. Currency expansion, money creation, and credit expansion became central features of the modern financial system. Today, central banks, like the Federal Reserve, influence the economy through monetary policy. They adjust interest rates, purchase bonds, manage the money supply, and engage in quantitative easing during periods of crisis. These actions inject new money into the financial system. But here's the critical question: who receives that money first? The answer leads us to one of the most important concepts in economics: the Cantillon effect. The Cantillon effect explained simply as this: new money never enters society equally. Banks, financial institutions, governments, and large corporations receive access to new money before prices fully adjust. They can spend and invest while purchasing power remains relatively high. By the time that money reaches ordinary workers and consumers, prices have already started rising. Inflation isn't distributed evenly. The benefits arrive first for those closest to the source of money creation. That's why inflation and wealth inequality often grow together. Imagine two people living in the same economy. One owns financial assets, stocks, businesses, and real estate. The other relies entirely on a paycheck. When inflation rises, asset inflation often follows. Stock market growth accelerates. Real estate appreciation increases property values. Businesses raise prices and increase revenues. Asset owners see their wealth accumulation accelerate. Meanwhile, wages adjust slowly. Paycheck purchasing power declines. The cost of living increase outpaces income growth. The result is that one person feels richer while the other feels poorer, even though both are experiencing the same inflation. This is one of the biggest reasons why inflation makes the rich richer. Wealthy individuals typically hold assets rather than cash. They own stocks, property, businesses, and financial assets that can rise alongside inflation. The middle class and lower income households often hold a larger percentage of their wealth in cash savings. Unfortunately, inflation acts as a hidden tax on cash. Every year that prices rise, the real value of money sitting in a bank account falls. This creates savings erosion and undermines long-term financial security. Inflation also changes how debt works. Most people think debt is always bad, but inflation creates winners and losers, depending on the type of debt involved. A fixed-rate mortgage can become an advantage during inflationary periods. The debt remains fixed while wages, rents, and property values gradually rise. Over time, inflation reduces the real burden of repayment. This is why many investors use leverage and fixed-rate debt to acquire appreciating assets. On the other hand, consumer debt and credit card debt often become more dangerous as interest costs rise and household budgets become stretched. The wealthy understand this distinction. They use borrowing and inflation strategically. They acquire asset ownership, using leverage, then allow inflation to reduce the real value of their liabilities while their assets appreciate. This debt inflation advantage has played a major role in wealth concentration throughout modern economic history. The rich are not simply earning more money. They are benefiting from a system that often rewards capital ownership more than labor. The pattern became especially visible after the 2008 financial crisis. To prevent economic collapse, central banks launched massive quantitative easing programs and large-scale bond purchases. Trillions of dollars entered the financial system. While these policies helped stabilize markets, they also contributed to significant asset inflation. Stock markets recovered rapidly. Housing prices increased dramatically. Financial assets appreciated. Wages, however, grew much more slowly. The result was a substantial increase in wealth inequality. The same pattern emerged during the pandemic stimulus era. Governments injected enormous amounts of money into the economy, while supply chain disruptions limited production. The result was the 2020 inflation surge. Prices climbed rapidly, housing became less affordable, and financial markets reached record highs. Once again, those who already owned assets generally benefited more than those who depended primarily on wages. Inflation amplified existing advantages rather than creating new ones. Throughout financial history, the same story repeats itself. In Weimar Germany inflation, cash holders saw their savings destroyed, while owners of real assets often preserved wealth. During the 1970s inflation crisis, real estate and commodities became powerful stores of value. Different countries, different decades, same pattern. Inflation redistributes wealth. Not randomly, but systematically toward those who own productive assets and away from those who rely solely on cash and labor income. This doesn't mean inflation is a conspiracy. Modern capitalism is built on credit-driven growth. Governments, corporations, and households all depend on borrowing. A debt-based economy requires ongoing economic growth, and growth often requires monetary expansion. Inflation helps reduce debt burdens and encourages spending. Without it, deflation could make debt heavier, increase defaults, and threaten financial stability. Inflation acts as the lubricant that keeps the modern economic machine running. The problem is that the benefits and costs are not distributed equally. Inflation rewards ownership more than labor. It rewards investing more than saving. It encourages risk-taking behavior and discourages caution. It changes consumer behavior, financial decision-making, and economic incentives across society. People save less because inflation reduces the real value of cash. They invest more because they feel forced to protect purchasing power. Inflation doesn't just affect prices, it reshapes economic behavior itself. And that's why inflation remains one of the most powerful forces in the modern economy. It's not simply a story about rising prices. It's a story about wealth transfer, purchasing power decline, asset ownership, debt, and economic power structures. It's the mechanism through which governments reduce debt, investors build wealth, and the financial system sustains itself. The next time someone says inflation is only about more expensive groceries, remember that prices are just the surface. The real story lies beneath, in the transfer of wealth, the expansion of credit, the rise of asset values, and the growing gap between those who own assets and those who don't. Because inflation isn't just making things more expensive, it's quietly deciding who gets richer while everything else gets harder to afford. If you enjoyed this deep dive into inflation economics, wealth inequality, central banking, and financial history, subscribe to the channel. Because history doesn't just explain the past, it helps us understand the future.